Hello everyone. The environment that we're seeing right now is a particularly complicated one. Why? Because what we're seeing is that asset classes continue to go up, equities, bond yields are coming down, and at the same time what we're having is an increasing level of uncertainty, particularly about global growth. If we look at this year, we're expecting basically a little bit more than 3% of increase in GDP. Next year, we would need China and emerging markets to recover quite dramatically to achieve a further 3.2%. So we're quite conservative in that assessment. We believe that global growth will continue to be subdued, and we need to be aware of that. Also, because it's quite concerning to see that yet again in earnings estimates, in EPS estimates, both for the US and for Europe, the market expects for next year more than a double-digit increase, between 12 to 13% increase. Now that is quite concerning, because what we are likely to see yet again is earnings revisions, and those revisions being downwards. In the US, we're much more reassured by the fact that the cuts in taxes will help boost earnings in companies that will not use corporate buybacks, share buybacks, to boost EPS. Therefore, we're more upbeat about the US yet again than Europe. And I would be quite worried about the exuberance about oil prices in particular. Compliance of the agreements between OPEC and non-OPEC countries is quite challenging, but also the US is very likely to offset part of those cuts, and unless we see demand improvements, it is going to be quite difficult to see this inflation expectations going up due to basically commodities to continue to be strengthened. Therefore, let's be cautious, because GDP growth, inflation expectations, and earnings estimates continue to be more weak than strong, and we need to be more reassured. So we will continue to monitor the situation and report it back to you. Thank you so much.